thyssenkrupp, the German-listed steel conglomerate, has been in the news following the sale of its elevator business. Since then, the share price has collapsed, trading volumes have soared and its credit spreads have spiked. It seems that investors are upset that the crown jewels have been sold and they're worried about its ability to survive COVID. In the past, we've criticised their accounting and the way they presented themselves. But we have to admit we were stunned by the results of the elevator auction. We think the private equity firms that bought it for double our valuation will need a lot of luck. But then again, they are incentivized to do deals, irrespective of whether they're good or bad. We think that this deal, the board changes, and the new CEO will transform thyssenkrupp. But before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. Selling their elevator business for 17 billion euros is miraculous. We think it's nuts to pay such a premium for a third-tier operator, but it should save Thyssen. Pre-sale, they had 11.4 billion of debt and other liabilities. Now, once the deal is completed, it'll have over 4 billion of cash and net working capital. However, the group's operational failings will be fully exposed. If management and the unions want to avoid bankruptcy over time, things must change. I'll use our typical governance, accounting and peer performance approach to highlight the issues. So let's start with governance. In the past, Thyssen had an oversized male-dominated board, some of whom had overseen the disastrous investment in Brazil and appeared to be blocking change. Nearly all of these old directors have gone and in many cases been replaced by females who we think will bring a completely different perspective. The old compensation scheme is still in place and it remains easy to manipulate. However, the CEO is talking about setting clearly defined key performance indicators, so perhaps they can try to avoid some of the sins of the past. Accounting. Thyssen's been very guilty of creative accounting in the past. In fact, the way that they cut the loss on the sale of the LATAM business in 2016 was almost magical, and we think their depreciation still looks a bit light. They sit close to the average for the industry at just under 5% of sales, but they do seem to consistently spend more than they depreciate, even though revenue never grows. This would suggest that their depreciation rates need to be somewhat higher and their reported profits somewhat lower. This under-depreciation is also one of the reasons why Thyssen often has to book provisions and/or book losses when they sell assets. The good news is that the elevator sale will not only generate cash, it will also lift equity book value. This and the COVID crisis gives the new CFO an opportunity to clean up the accounts. It'll mean large losses this year, but it will make it much easier for them to meet their future performance targets and impress investors. It may even mark the end of the constant adjustments to EBIT and the pretense that the adjusted EBIT numbers are real and recurring. Another way reality is being distorted is the use of conglomerate accounting to present profit split between the operational units. It's very handy for management because they can shift costs at will to head office, so making the operating units look more profitable than their peers, who just can't do this. To make a realistic comparison, you need to reallocate these costs. We allocated them based on headcount, and as you can see, it has a material impact on their margins. Performance. After allocating the costs, it also becomes clear that the employees' share of revenue is generally much higher than their peers. They're either less productive or they're simply getting paid more. This needs to be addressed if Thyssen is to ever become sustainably profitable. A simple comparison of personnel and other costs illustrates the problem, and based on our benchmarks, we think 16,000 to 19,000 jobs need to go. The company is taking a different route, but it seems that they agree with our result. They're carving out a loss-making entity with Euro 6 billion of revenue and 20,000 employees, which they hope to eventually sell, leaving behind a profitable and rather more productive core. For all the good news, we acknowledge that steel at the moment is in a very tough market, and German production is probably in long-term decline. It's now a minnow when compared to China, and so potentially vulnerable to Chinese exports. Steel spreads are also very tight, and so it's hard to be profitable. Add in the COVID impact, and it's no wonder that Thyssen is in a difficult place this year. But this will pass, the economies will restart, and steel buyers will come back. And if Thyssen's been cleaned up in the interim, it should be very profitable and cash generative. On the most recent reported numbers, Thyssen looks quite similar to its peers, but adjusts for the elevated cash and its EV to sales falls dramatically. All in all, we think it's a very interesting story and worth investigating if you're happy to look at value stocks. If you want to dig a little deeper, visit the thyssenkrupp page on bucephalus.com using the link below. There you can see the questions we think investors should ask and download the recent filings where we've highlighted the key points. To keep up with our reviews, subscribe to our channel or send us an email. Before you go, please remember, none of this should be taken as investment advice. We've sourced the facts from company documents, but the interpretation and conclusions are just our opinion. We provide these videos for education purposes to expose what we perceive to be creative accounting. They are subjective and should not be used as the basis for an investment. Thank you very much for your time.